Good morning, everybody, and welcome to the Seiler Wealth Management video blog. I'm Lee Seiler, also known as the Stock Doctor, which my website is that namesake, www.stockdr.com. Check it out. There's some really, really good stuff on there. Let's talk about what's gone on thus far this week. The market has staged a little bit of a rally despite all the Brexit. I want to make sure that we understand that again, and I'm sorry for those of you that do understand, but we do have some people new coming on and listening to these webinars, so I want to make sure you understand. So it's basically the British exit from the European Union. The vote is today. They're voting as we speak. Now, Wall Street doesn't seem to be that worried. A week ago, they were worried, and then the polls got a little bit closer. It was more leaning towards a week or two ago of a most certain British exit from the European Union, but now it appears it's too close to call, and it looks like speculation says that the Brits will stay in. I figured they probably would stay in, and this is maybe some kind of ploy to negotiate another deal of some sort, but we'll see. Okay, again, the European stocks are rallying on the news. The pound is rallying, so that's a pretty good sign there. If they do exit by chance, this is something that will take years to resolve. It will get a little bit messy. Investors, Wall Street does not like uncertainty. You hear that term a lot, but that's a fact. When there's uncertainty, you don't like it. Meanwhile, the markets are really trading in a range. It was down 1% last week. We're probably up about 1% this week. Not a lot going on. You have the summer doldrums. One thing you have to look at, there's some merger. There was actually a First Technology IPO yesterday, first time since late last year. So maybe we're going to start seeing some more IPOs come out. Not sure how it's going to perform. It's going to come out today. Also Tesla, okay, the electric car manufacturer, they're buying, it's a weird deal. They decide to buy Solar City, which is a solar company. Now you start thinking, okay, well, the batteries are really, really expensive. First thing I thought of is that maybe they're trying to have these batteries rechargeable, and that's why they want to get in bed with a solar company, so it'd make it more feasible to longer life, et cetera, et cetera. We don't know what Elon Musk has in mind. The deal, Wall Street hates it. Tesla, the stock itself, TSLA, trades on the NASDAQ. We do not own it. Thank you. I did make money on the stock about twice, and then I got cut. I said, no way, I'm not going to do that anymore. Very volatile, extremely volatile story stock. Stock got hammered, down about 10% on the news. Even Solar City, which is being the acquired company, was up and then came back down, up a little bit, but not as much as you'd think on a company that's getting acquired. So Wall Street is really losing its love for Tesla. Morgan Stanley, who has been a big time advocate of Tesla, thinking that stock could be a double down the road, has now changed their rating to equal weight. So, their sponsors are starting to get a little bit skittish about what their plans are going forward. Now, look, they make a great car. I test drove one. Great performance. It's an awesome car. I wouldn't buy one. I just don't believe in spending $95,000 on a car that you can only drive 350 miles before you have to sit there and wait to get charged. Don't like that. It's not my thing, okay? But I know it's a lot of other things. People in California buy them like crazy, because here's why. In California, you get a $15,000 tax credit, not a write-off. Literally, if you owe $20,000 in taxes, guess what? You only owe $5,000. It's an actual credit. If you don't owe anything in taxes, you will get $15,000 in your pocket. Okay, that's how it works. The state of Florida, and I think most states, have a tax credit because, of course, the environment, and the tree huggers really love this, but $7,500 tax credit in the state of Florida. So a $95,000 car really is going to cost you $87,500. But again, they're great cars. The acceleration's fantastic. They're fast. They've got all the modern technology. It's just, it doesn't suit my lifestyle. It may suit yours. I love seeing them on the road. They're pretty cool. So, look, I don't know where Tesla's going. Certainly, it's not a buy. I would not be a buyer of the stock. I know some people want to short it, and I've been reading that. And they're probably going to make money on the short side, but I always feel just nervous shorting a stock after it's already gapped down $20-something, because it's almost like shutting the barn door after the horses have already been gone. So that's a little scary, but I would think that you probably have a little bit of profitability on that short trade. Shorting a stock means that you think it's going lower, so you sell the stock without owning it. with hopes to cover or buy it back at a lower price. So let's say this is your short lesson for the day. And it's a very risky proposition, folks. This is not for the average investor. This is for really a sophisticated investor. But if you think a stock is going lower, you say, okay, I see Tesla at $200. I think it's going lower. You call your brokerage firm. There's a way to do it. You have to borrow the stock first. You can't just sell it without having access. You have to get it from somewhere. So once the stock loan department will say, yes, you're good to short 200 shares of Tesla. Great. So then you put a sell order, a sell short of Tesla. So you sell the stock at 200 in hopes that, hey, the stock drops to 150. I buy it back and cover that short and make 50 points. That's how a short works. There's other ways to do it too. You can do more speculative bearish trades by buying puts. If you think it's going lower, you can buy puts for literally very cheap prices, but they expire. So it's a really risky trade. But anyway, that's just, we talked last week about different types of orders, stop orders to protection. But a short order is one way to do it too. That's another trade, again, only for the sophisticated. So don't go out there and start shorting stocks thinking you're going to make money. And one thing that I've always learned, I've been doing this, I'm in my 29th year. Yes, I don't look that old. Okay, my 29th year. I've learned you never, ever, ever short a dull market. And that's what we are. And whether I think the market's going lower, which I do, I think that I've been saying it, well documented, 4-8% correction. We were down 3% last week, rallied up a little bit this week, but I think we're going to be between 4 and 8%. No major pullback, but just something minor. Take a little bit of froth out of the air. But you never short a dull market, because all of a sudden, some good news when nothing's going on, if you get some good news, you can get whipsawed. And what happens is, what's happening today in Japan, the Nikkei market is rallying. And why are they rallying? Because it's really a short covering rally. So let me give you the other side, or the negative side of a short situation. Let's say you've shorted Tesla and you're doing great. Stock, you shorted at 200, it's at 180. You're making 20 points on it right now. All of a sudden, Tesla says, guess what? We're not going to buy Solar City because Apple's going to buy us. Then that stock, before you have a chance to cover, gaps up to $225 a share. Now all of a sudden, you're down 25 points, and your loss potential on a short trade is infinity. Think about that. If you go long a stock, meaning you buy a stock that you want to own, you're limited to your downside to what you paid for the stock. You buy a stock for 200, guess what? Your downside's 200 points. You short a stock, it could go to 500, 600, okay? So at some point, you got to bite the bullet, take your loss. And that's where the risk comes in on a short side, because I've been involved in these. Years ago, I was involved in a dull market. We shorted it. It didn't work out. So I've learned my lesson. And I've learned plenty of lessons over the 29 years. That's why we have a lot of clients that are here and they're happy with us. So that's what happens. If something, all of a sudden, we're not going to buy Solar City, Apple, stock goes up to 225, then everybody piles on to buy back their shares. That's called a short squeeze. And now what's going to happen? The stock that has been stretched to the downside is going to catapult, because all the buying pressure is going to gap it up even further. That's the risk you run. Again, if you really have this burning desire to do something that risky, consult a financial advisor. I know one that's really good that can help you, okay? Very simple, stockdr.com, all right? Thanks for joining me today. We'll see what happens. Again, I don't think Britain's going to exit. We'll see. I think the market's going to be okay with it, but then we'll be back to the doldrums next week. You can catch us on stockdr.com. Ton of great information. I'm changing some things up on there as well. You can call our office. We're doing a ton of 401k rollovers, a lot of IRAs, and we have a new program. It's the SOS program. It's a second opinion service. I mean, a lot of people have portfolios out there, annuities, life insurance. At least let's get a second opinion, see if you have the right thing, because, one thing for especially, insurance rates have gone down. People don't realize this. Life insurance rates have gone down because people are living longer. So if you have an old policy it's been sitting on, you're probably paying too much. So let us shop around for you. Let us see. We have a department that can handle that. In the meantime, I'm Lee Seiler. Thanks for joining me. StockDR.com, Seiler Wealth Management, and you guys have a fantastic weekend.